newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, Canada has withdrawn its digital services tax on technology companies such as Meta and Alphabet in a move to restart trade talks with the U.S. Now, earlier, President Trump said the U.S. holds all of the cards in negotiations.
Canada's been a very difficult country to deal with over the years. We hear Canada, we have a great relationship with the people of Canada, but it's been very difficult. And they put a charge, and they were a little bit early. We found out about it. And we have all the cards. We have every single one. We don't want to do anything bad, but they have economically, we have such power over Canada.
Well, joining us now is Roz Matheson, our EMEA News Director. Roz, Canada dropping the digital services tax. Will it move the dial?
Well, it does mean that trade talks can restart, and the goal here is to get to a deal by later in July, around July the 21st. And the digital tax was potentially holding things up, but also it was probably more a bargaining chip than anything else. I mean, this was a bill that was brought in by the previous Canadian administration. It wasn't Mark Carney's baby. He could actually give this away without giving too much away. And this does force the restart of the conversation with the US. So if Donald Trump was hoping to stymie the trade talks by holding this bill up, then Mark Carney's just blown right through that. It's interesting because in that clip, Donald Trump is talking about having all the cards. And of course, Canada, Canadian exports, 3/4 of them go to the US. So that is leverage. But equally, Canada is the biggest buyer of US goods. So there's a very, very intricate, complicated mutual trade relationship going on here that's going to be very, very complicated in terms of getting to a proper, deep trade negotiation versus some of the broad framework understandings that we've seen happen so far in this US administration. But it does seem that this was more a bargaining chip than anything else. It'd be interesting to see if Donald Trump now turns his attention to the digital services taxes that are in place around the world. For example, with the UK, does that come back to the fore in the conversation, or was it really just about how or whether to lean on Canada to get these talks moving?
And Ross, domestically, the focus is on President Trump's multi-trillion-dollar tax and spending bill. Where do we stand ahead of the deadline this Friday?
Well, that's right. So we're going into a pretty fraught period, what's known as the votorama expected Monday, which is many, many hours, possibly 12 hours of debate on the Senate floor. What the administration needs is some of these 8 senators are holding out over the line. It can only afford to lose 3, and they're quite a way apart, which is the challenge. Some senators wanting further spending cuts, some senators wanting more protection for things like Medicaid or a slower removal of some of the green credits that are due to roll off. And so there are quite differences in what each of these senators is looking for. So you can lose 3, but not any more than that. And if this bill gets amended, of course, it has to go back to the House again. And so getting it towards the July 4 deadline remains very complicated. There'll be a long debate and discussion in the Senate, likely starting later today, as I said, called the votorama. And the question is, at the end of that, where are we at? Do we have something that can progress? Does it have to go back to the House, or do they lose more senators than they can afford?
Roz, thank you so much. Terrific briefing, as always, from Roz Matheson, our Bloomberg EMEA News Director. Now, private credit has become one of the most talked about asset classes in the past year, of course, also as we watch negotiations in the U.S. But this comes as both institutional and high net worth investors look for new ways to diversify their investment holdings. Now, a firm that was an early adopter of private credit is Oaktree Capital Management, an alternative asset manager with over $203 billion of assets under management. And we're joined by Armen, Panossian, co-chief executive and head of the performing credit at Oaktree Capital Management. Armen, so good to see you, and so good to see you actually in London. There's really quite a lot to talk about. Where do you see, first of all, the best opportunities in the U.S. and Europe?
Both areas have some interesting opportunities, but Europe, I think, has probably shifted the most in terms of a positive forward trajectory in terms of the opportunity sets. First of all, in Europe, we did not see the same level of exuberance in aggressive capital structures and buying activities like you did see in the U.S. that were fueled by growth expectations. Second, from a legal perspective, Europe has a very strong backdrop in terms of creditor protections and a tighter community And then third, Europe is now stimulating its economy by spending, especially in continental Europe, spending in terms of defense spending as well as its industrial backdrop. So we're seeing a broad-based increase in M&A activity in Europe and probably a little bit less so in the U.S. At this point.
Where do you see infrastructure and real estate opportunities in Europe? Is it country by country, or are there certain projects that look attractive?
So we're a bottoms-up investor. So I wouldn't say that there is a top-down view of which country we ought to invest in and which we shouldn't. I think the clearest opportunity is probably in Germany. Mainly because of the debt to GDP starting point for Germany. But right now, I think it's still early days for us to really pick our spots. We're just kind of watching carefully and from a project-by-project basis, deciding where we ought to invest or lend against.
So, Armen, what's the trigger point, actually, for you to deploy capital and invest heavily?
We're ready to invest now. We have a tremendous amount of dry powder at Oaktree across all of our strategies, and we're ready for the right opportunities that are structured appropriately. We tend to like to invest more when there is a dislocation, and we don't see very much by way of dislocation anywhere right now. So we're going to proceed cautiously and looking for just kind of our steps as they present themselves rather than make a big market call and push in all at one time.
When you look at the U.S., is the housing market turning there?
It doesn't appear to be turning. The pricing is holding steady, but the volumes are quite low.
Okay.
And so housing prices are being supported by a decline in volumes. For now, at least, it seems that banks, in terms of commercial real estate, are just kicking the can down the road. And so we're not even seeing a tremendous amount of dislocation, but for very specific office markets in the U.S. I think the regulatory environment supporting banks is quite conducive following the failure of Silicon Valley Bank. And so nobody wants to see another bank failure, and we're seeing that play through with some relaxed regulatory adjustment towards the banks.
I mean, I keep on, being asked why there's not more volatility in credit markets. And I'm not sure why that is. Is it, demand from life insurers? Is it something else? Or is it just, dodgy market dynamics at the moment?
Yeah, so it's a great question. I think from a very big picture perspective, there was a lot of stimulus dollars printed during COVID. Okay. And when that capital spun through the economy, it made its way into the hands of savers. Those are insurance companies, corporate treasuries, high net worth individuals, and others. And so those types of investors are quite broad-based. And we're seeing all of them demand credit. They're actually demanding equity as well. You see the U.S. equity markets at all-time highs again. And it just shows you that there's a tremendous amount of demand and liquidity for investment assets. Now, the reason credit in particular is attractive is because base rates are so high and spreads are at attractive levels. They're not super tight and they're not super wide, reflecting any sort of stressed scenario. But when you add the base rate plus the spread across both public and private credit, it's a very attractive total return, and I would say it will likely outpace equity returns over the medium term.
So that won't change the appetite for credit markets, and you could likely actually see more buyers or more investors coming into this space.
We do absolutely see it. In April, when we saw the credit spreads back up a little bit, they widened probably about 150 basis points when the tariff news came out. We saw a tremendous amount of inflow coming into both public and private credit at that time.
Armen, your firm also raised some $16 billion on some of the flagship special operations funds. What's the fundraising climate out there?
For credit, it's actually quite good. I would say, though, it's quite broad-based. It's both private and liquid credit that is of interest. Liquid in particular, I think is a great purchase right now, just again with base rates being where they're at and the ability to get into a liquid opportunity and get fully invested immediately and earn somewhere in the high single digits coupon on a contractual basis. I think that's a very attractive proposition as it compares to pre-COVID. You were getting sort of mid-teens for high yield, mid-single digits, for high yield bonds, and now you're getting high single digits. And it's a great environment for that. I think on the private side, because private equity is quite slow to deploy and to return capital, I would say private market fundraising is a little bit more challenging than the liquid credit markets are.
And does that change as there's a bigger, I guess, understanding of where the economy is headed? or is it something that is structural and will be here for quite some time?
I think it's here for quite some time. I think investors have come to appreciate the exposure to private markets, especially private credit, the stability in the cash flows, the stability in the marks, the stability in avoidance of defaults has made it a core allocation for many institutional and high net worth clients, and we're only seeing growth in that regard. I think to the extent that there's any sort of minor hiccup in private market fundraising really relates to a tightening of spreads that's occurred in private credit, and so a little bit of a tapping of the brakes, but I wouldn't say the flow has stopped. In fact, the flow continues to be quite strong. I would just say it's slightly reduced from where it was maybe 12 months ago.
And Armen, what does it mean for staffing? So are you hiring? Are you hiring in certain spaces? Does the UK, for example, look attractive?
We're always looking for strong talent across all of Oaktree strategies. And yes, the UK is a particular area where we are hiring for deployment both in the UK as well as into continental Europe. It is absolutely a growth area for us.
Why the UK?
Well, UK represents about 30 to 40% of deal flow in the private, especially the private credit markets across all of Europe. So it is a very large part of what we do at Oaktree across all of our strategies. We certainly have a large office in the UK, and building onto that office is preferable versus having a bunch of satellite offices. So the UK market is quite robust and most similar to the US in our opinion.
I mean, there seems to be quite a lot of software lending, right? This seems to be a really big focus for private credit. What's your view on that, and in general AI, and how the two play off each other?
So there is a lot of software lending. I would say that it's been a very significant area of leveraged buyout activity for the last 8, 9, 10 years. There's some very large private equity firms that are quite good in understanding software and executing a business plan that makes sense in software. Software is either the first or second highest concentration in the broadly syndicated loan market, which appears to be achieving sort of its limit on how big it could go. And as you see slightly more aggressive software LBO transactions, they are making their way into the private credit markets. And so there is probably a 25 to 35% allocation in terms of new deal flow that we are seeing in large software LBOs. I think in addition to that, you mentioned AI. AI is a very attractive investment area. Nobody's really talking about the societal issues around AI, but from an investment standpoint, there's a tremendous amount of spending that needs to happen in the entirety of the AI ecosystem, both in terms of hardware and software. And that's a very intoxicating feeling from an investment standpoint, where you say, I could pick my spots from a regional perspective, I could pick my spots from a hardware and software perspective, from a service perspective. And so it sort of opened up a brand new investment opportunity for private equity firms and growth equity shops, but also for private credit managers like us.
Armen, is there a danger that actually, because the money's chasing AI, then there could be some, big outstanding loans at risk in software companies?
Absolutely. I mean, in any industry that experiences a great boom, there is the opportunity for excesses as well. I think about the fiber optic boom in the late 90s and early 2000s, where initially fiber optic CapEx or build-outs were done based on contracted capacity. Eventually, that fell away, and capacity was built without contracts in place. The same is starting to happen in AI with data centers. So it is an area that we are watching. We're careful about not chasing that exuberance. So we're looking for appropriately structured loans with appropriately capitalized companies and owners.
So interesting. Armen, thank you so much for joining us. I hope you come back really soon here in the studio. Armen Panossian, co-chief executive and head of performing credit at Oaktree Capital Management. Now, coming up, the world's top central bankers gather in Portugal amid global uncertainty. We'll find out how they're navigating Trump's presidency. That's next, and this is Bloomberg. Welcome back, everyone. Now, the world's leading central bankers will meet to discuss monetary policy at the European Central Bank's retreat in Portugal this week. Now, they're likely to discuss inflation and growth as they navigate President Trump's presidency. Well, joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management, and Moritz, Kraemer, Chief Economist and Head of Research at LBBW Bank. So thank you both for joining us. Seema, give us an indication of how, concerning or what questions you would have on how central banks navigate volatility in the price of oil, because I haven't really discussed this together since last year when oil wasn't a problem.
Yeah, I guess it's interesting because we have been, as investors, we've been less concerned about the price of oil. Over the years, it's just become less and less concerning from an inflation perspective. And I think, but what the key question for me would be, and this really relates to tariffs as well, is that, how much emphasis are they putting on short-term inflations versus long-term inflations? I think that's a key discussion, because if you're looking out across the break-evens, of course, there's pressure at the front end, but the long end is really quite suppressive, has actually come down a bit. So I think getting that kind of understanding and seeing how central bankers are discussing that would be key.
Yeah, and Moritz, I know you spend a lot of time looking at, euro area inflation, which just seems to be going down quite nicely.
Yeah, it's going well, I think. And it's going pretty well in almost all countries. Some are a little bit above the target, some are below. But by and large, the ECB can be very content with what it has achieved. The core inflation rate is still a little high, that's true, but I would assume and predict that this is going to come down as well, to the extent that, first of all, we have the appreciation of the euro against the dollar, for example, but also you have a declining trend in terms of wage settlements. So the big settlements after the inflationary shock, they're fizzling out. So I would think the ECB is in a pretty good spot, and Christine Lagarde can go relax to Sintra.
Yeah, I don't know about relaxing, given everything that's going on.
Well, compared to Jay Powell, anyway.
Compared to Jay Powell. Can the ECB cut one more time? Because I guess, to have interest rates below 2%, it feels like the economy should be in a really bad place.
Yeah, I would think they're going to cut one more time, probably September-ish. But really doesn't make a big difference whether they cut one more time or not. And you're right, if you have the policy rate below the inflation target, that signals sort of some concern. I think they want to reserve judgment until we really know where all these trade deals are going. And so far, the visibility is poor, so I think they wait this out and see where things are going.
Seema, where do you see, again, Moritz is right, Jay Powell can't really relax on a number of fronts. It's like his independence being attacked, markets move just on speculation that there's some kind of shadow, Fed chair being appointed in September. Like, what's his biggest juggling act? Will he just push back and say he's not moving until inflation does something?
Yeah, I think so. I think he has to ignore all of the noise. He's leaving next May, whatever happens. So it doesn't make any sense for him to try and get involved in a lot of the political saga that's going on around who's going to be the next chair. But I agree. They have such a dilemma at the moment. They've got the unemployment rate looking very suppressed at the moment, but with concerns it's going to increase. Maybe, maybe not. Same thing with inflation. Is it going to go higher or not? And then you've got a lot of, as you said, voices, but real concerns again, where is neutral? So from my perspective, very similar to what it is for Lagarde, they need to wait until they have more policy clarity. At this kind of environment, when you have inflation above target, but potentially rising, and the economy is strong but potentially slowing, that is really ripe ground for a policy misstep. So the best thing they can do is really sit still and just wait to see how that data pans out.
Yeah, it's quite slow, actually, to transfer onto the data. A lot of the ugly surveys that we had after Liberation Day. Is it normal that it's taking that long, or is the economy behaving differently to what we could have expected?
Well, it's two things. So on the inflation front, I think it absolutely makes sense. It does take a couple of months, 2 to 3 months, before you see that inflation. I guess the price increase is feeding through to inflation. So we wouldn't anticipate to have had any kind of sign of it until maybe the next inflation print, or certainly into August is when we'd expect to see those numbers increasing. For the economy, though, I think the big learning for everyone has been just the resilience of the US economy. And when you go down to it, the balance sheets for households and corporates really does suggest that it's able to withstand a number of headwinds. So I think there's a couple of things to play. And then, of course, don't forget about immigration. The drop in labour supply is going to have a real impact on the way that we're going to be seeing what the payroll prints actually mean to the underlying economy.
Moritz, how do you look at the labour market in the US?
Well, the labour market remains tight. Obviously, the Fed has a potential dilemma, weakening labour market and increasing inflation. I would think the labour market's actually going to hold up stronger than some people expect, especially if you have extradition of maybe millions of undocumented migrants. But I would expect the Fed and Jay Powell specifically to be very cautious because if you're moving away from the target, both on the full employment target and the inflation target, you're just coming out of an inflation disaster, right? So we had inflation in sort of near double digits, and you don't want to do this 2 times in a decade, so you lose total control of your inflation target by sort of thinking, well, this may be transitory or not. So I agree with Seema. This has all the trappings of a policy mistake, and I think they learned from the first time round, and they're not going to do it.
So what does that mean? 1 cut this year,
none,
if anything?
None. I see none, no, because I don't really see the potential. If inflation is going up, why would you cut rates? And Donald Trump doesn't actually serve his purpose by sort of lambasting Jay Powell, because I think this will just increase the resistance, because the Fed has no appetite of appearing like the Central Bank of Turkey, who's doing the bidding of the president.
Do you see 1 cut?
I do. I see one, but very late December, if anything, pushing potentially into 2026. And the key thing is that if they were to cut rates before the end of the year, or certainly July, September, then I think Trump's going to move into fairly dangerous territory, because the market is going to get concerned about what happens to inflation in the future. Mm-hmm. And you're going to see the upward pressure at the long end of the yield curve, which is the exact opposite of what he's hoping for.
How much, Seema, should we worry about stagflation? And I know stagflation broadly means different things to different people, but is this really what monetary policy should be watching out for?
Well, I think it's right that central bankers are going to be very careful. You know, as Moritz was saying, having come off the second, already one very significant inflation shock, they can't afford to have a second one, because then you really start to question credibility, inflation expectations becoming unanchored. In this situation, yeah, I think inflation is going to go higher. But again, I also don't think that the labour market is going to deteriorate too much. So potentially stagflation-like in terms of directions, but I don't think a major concern, just something that central bankers do need to be cautious of.
Moritz, is there a blind spot that they're not worrying about where they should be worrying more?
Well, I think it's not really blind, but I think markets are still a little bit blasé about public finances and the supply of treasuries. Now we're having the so-called one big beautiful bill sort of inching towards the finishing line. The White House denies that this would increase the supply. I think this is highly implausible. I'm definitely with the Congressional Budget Office on this one. And we're already starting from a totally unsustainable situation. We're in peacetime, we have full employment and a 6% deficit, quickly rising. This, at some point, something's going to crack. Whether this was going to be in a month, in a year, or in 5 years, I'm not able to tell. If I was, I wouldn't be sitting here probably today, and I wouldn't tell you. But something's got to give at some point, and either it's reform on the policy level, or the markets will react. And we know these are not slowly gradual reactions; they can snap.
Yeah, Moritz and Seema, thank you so much. Seema Shah, their Chief Global Strategist at Principal Asset Management. Moritz Kraemer, Chief Economist and Head of Research at LBBW Bank. Coming up, we'll discuss the impact of Europe's defense spending push and explore the outlook for commodities with Carlyle's Jeff Currie. That's next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Canada backs down, dropping its digital services tax as it looks to restart trade talks with the U.S. Progress in trade negotiations adds to upbeat market sentiment that pushed U.S. stocks to a record high. And President Trump's $4.5 trillion tax cut bill now shifts to the Senate for a marathon voting session as the July 4th Friday deadline looms. Now, on to defense, and Ukraine says Russia fired a record 537 missiles and drones in massive attacks over the weekend. Now, Kyiv claims that air defenses repelled 475 strikes, while Russia says all designated targets were hit in the large-scale strike. Let's bring in our Greg Sullivan. Greg, thank you for joining us on this Monday morning. What can you actually tell us about the strikes?
Well, as you said, this was the largest drone and missile attack in terms of number of ordnance that was fired since the start of the war. It also fits into a pattern that we've seen of an uptick in these strikes that have been happening in recent weeks, with Putin likely trying to put pressure on Ukraine amid ongoing talks to agree to certain hardline demands that he's made. Now, it's also important to note that this comes as the U.S. and Europe have been pressuring Moscow to agree to a ceasefire. The two sides have started talking for the first time since the early days of the war, and while they've exchanged prisoners, there's been little sign that they're making any progress, though, on any kind of ceasefire agreement.
So, meantime, Vladimir Putin also tightened his grip by expanding secrecy laws. What impact do those have, Greg?
That's right. It does look like he is taking advantage of the war and the war situation to try and tighten his grip on the control of information in Russia. Under this new decree, information about things like economic and trade policy, foreign policy, scientific development will all be considered classifiable, which basically just takes a whole swath of information out of play. Of course, Russia has been tightening their grip on information, their crackdown on dissent since the start of the war, and even before that. We've seen activists and journalists get hefty sentences, and of course other data is already classified, like some economic and budget data, and of course Russian casualties still remain classified.
Greg, thank you so much. Greg Sullivan there with the very latest on, of course, Russia and Ukraine. Now, the Italian shipbuilder Fincantieri planning to focus some Italian civil and military shipyards on just making warships. It's really the latest sign that Europe's defense spending bonanza is reshaping industrial strategy. Well, buyout group Carlyle says European defense investments could soar from current levels, and this could create a major opportunity for private capital. Well, I'm delighted to be joined by Jeff Currie, Chief Strategy Officer of Energy Pathways at Carlyle. As always, thank you so much for joining us, Jeff. I'm excited because you talk about, commodities and oil so well, and now you're really going into the defense spending. Now, NATO members agreed to boost defense spending to around 5% in response to Trump, but also to Putin. Mm-hmm. Were you surprised by the pledge, and how do you see it impacting spending overall?
Actually, I don't think it's so much a surprise that it's happening. It's more like, why did it take so long? And I think a lot of it has to do with higher interest rates exposing the severity of the imbalances. And from a financial perspective, what we're witnessing right now is an unwind of the capital misallocations going back to 2008 and arguably all the way back to the fall of the Berlin Wall in 1989. Driving those misallocations, one was the GFC. The United States had the biggest stimulus, both monetary as well as fiscal, and it has all the plumbing to be able to accommodate that. And you can see that in, whether if it was in the banking sector, capital markets, all of it attracted that. The second factor was the Mag 7. And we're going to talk about defense in a second, but why doesn't Europe have a Mag 7? It had no military industrial complex, because with that comes GPS, internet, AI, all of that are extensions of the military industrial complex. And then the third one is we're unwinding the trade imbalances. What's the flip side of the trade imbalance? Capital inflows into the United States. And so what we're seeing is a rebalancing of global capital flows. And we think we're in the midst of a major capital rotation back towards Europe and towards the rest of the world that was, going back to 08.
I mean, your defense spending, prediction is massive. It's $14 trillion. Does the NATO spending actually help in making that a reality?
Well, 14, let me put this in perspective. The China boom, the BRICS boom in the 2000s was 10 trillion. Put it in today's dollars, like 15.8 trillion. So we're in that magnitude. Now, the 14 trillion is they do everything right.
Right.
The worst case scenario was 4 trillion, but even 4 trillion, that's a major capex boom cycle. And let's not forget, Europe really hasn't invested in defense going back for 75 years. So this is a big shift. And it's not, people, the macroeconomists say, oh, there's no cyclical benefit of defense spending. That's true from a demand perspective, but let's think about it from a supply perspective. I want to go back to, why doesn't Europe have a Silicon Valley? Why was Silicon Valley called Silicon Valley? The U.S. military needed chips to go in the B-70 bomber and the Minuteman missiles that didn't melt. So having a defense spending or a military industrial complex is a boom to productivity, technology. So there's a lot of side benefits. And one of the big benefits that we see at Carlyle is, why was VC created and private equity created? To actually allocate that capital from the U.S. military industrial complex. So this is huge. I like to say it's back to the future for private markets.
Jeff, so does this change everything with Europe, but in what time frame? Because it takes time.
Yeah,
if you have any industrial plan and then a defense plan, it's time and to also find the technology and find the right investments.
Right. And I think let's go back to the BRICS boom of the 2000s. It took a decade to allocate that capital. Once you built the infrastructure to allocate that capital, then you overkill it, and you'll overkill it here as well. But I think the key point is, this is not a flash in the pan. We're just beginning that process. And, I've lived through 2 of these capital rotations. One in 02, 03, when the capital left the Silicon Valley and went into the BRICS, and then another one in 14 and 15 when it left BRICS and went into Silicon Valley. So we're on another one of these right now. So.
Yeah, and you've been coming on the show and saying, look, we've been underinvested in so many key parts of the economy, including, energy and security in general. What role can private capital actually play in helping Europe develop its military?
Well, you need an industrial policy to be able to funnel this capital into the right place. You can't trust something like defense to the vagaries of the public markets, and you don't want to put it all in the hands of a bureaucrat. That in between, the happy medium is the private capital, because it's a way to be able to maintain some type of control, but to make sure that you still get the balances associated with market pressures. So, that's the reason why the U.S. relied so heavily on it.
But the question is will Europe be as open, right, to Ps and VCs that the U.S. was?
Yeah, because trying to allocate it directly, particularly with the regulatory framework in Europe, is going to be really difficult. Right. And so, like Airbus is kind of a Lego approach to, doing aerospace. And doing that on a larger scale within Europe, across borders and everything, private capital is going to be the most efficient way to make that allocation of capital.
Do you have any specific projects that you think will kickstart, if those go well, then it will attract even more investment?
I want to emphasize, Carlyle has a long history in aerospace and defense. We've done 45 deals within the aerospace and defense sector. At this point right now, is basically bringing in information, understanding what the space looks like. But Europe didn't completely get rid of its defense sectors. There's still a lot of mom and pop private held companies. Like France has a database that has over 1,000 companies that are dual purpose, commercial as well as defense. And so the opportunity in Europe is not as remote as I think people think. But I think it really starts with the private sector and these smaller type of companies that are more dual purpose.
We've also talked in the past about renewables. I mean, is it now, energy security that is the right word, but at the end of the day, will money and capital find the same deployment?
Yeah, energy security and, non-fossil fuels go hand in hand. I like to point out that France has the lowest carbon footprint of any industrialized nation in the world. And it did it in the 70s and 80s when it built all that nuclear capacity. And why did it build that nuclear capacity? Not because it wanted to save the climate, but rather because it wanted energy security. Another thing, take China. China has cutting-edge nuclear technology, solar, EVs. We know the list of what they can do. Why did they develop? They didn't develop it to save the climate. They did it for energy security reasons. And we think about fossil fuels. Why do we like them? They're portable and storable. But why are they dangerous? And as we witnessed with the potential shutdown of the Straits of Hormuz last week, it's because they're portable and storable. And the sun shines for everybody, the wind blows for everybody, and nuclear power is the size of your fist to power a city. You don't have that same risk that you have with fossil fuels. So I think the energy transition speeds up with this focus on security, doesn't slow down.
I mean, isn't it crazy, though, that we're just thinking of security, either energy or defense, in 2025? We should have seen it like 5, 6, 10 years ago.
Yeah, but again, it goes back to that point. What has really changed here? I think a lot of it has to do with the 0% interest rate policies masked a lot of these imbalances. And now that interest rates are back up 4.5%, 5%, it starts to expose how serious these issues are and why they're hitting the burner today and they didn't do it 5, 10 years ago.
Well, what do you think will happen in the Middle East? I know there's been talk about a possible regime change in Iran, which then would unlock a lot of barrels.
I think the existential threat of Israel and Iran definitely is receding right now. I think that. But I think an important point here is the U.S. didn't even blink over concerns about the Straits of Hormuz. And it had to do with the fact that they're energy independent now. And that's a critical change. Again, why are these things happening today and they didn't happen 5, 10 years ago? 5 or 10 years ago, the U.S. would have been afraid to go into Iran because what if they did block the Straits of Hormuz? Now they're not dependent upon oil. And for Iran, you can't punch the guy that's hitting you if they don't feel any pain from it. And that's why the Straits of Hormuz weren't an issue for the U.S. and that Iran didn't want to pull. And I think it goes to a broader point here. These energy security issues, the U.S. no longer has a concern to police global sea lanes to protect the oil trade because they're not dependent upon it anymore.
Yeah, but so what kind of, I mean, they still, if you think of the shale in the U.S., they need a certain level, otherwise it just doesn't work. Yeah. So does it balance, does it balance out if you go into strikes in Iran?
Well, I think the U.S. definitely needs prices above 65, 70, right. Kind of basically where they are today. And you'll notice the administration went from 50 to 55, 60, and now it's 70. So they're kind of getting that message that you need to be in these levels. But I think people are very bearish because they believe there's this big surge of OPEC production. I want to emphasize, the 30 years I've been doing this, I've only seen 2 bear markets driven by supply. One in 14-15, another one in 1986. Producers don't shoot themselves in the foot, usually. And I think in this case, OPEC's going to be very data dependent, watch what's going on. And by the way, demand everywhere is surprising to the upside. In fact, I think we're on the position to see global synchronous growth for the first time in nearly a decade. Because you have the U.S. is actually looking much stronger right now. China's been surprising retail sales, exports, container traffic, and now Europe has released the debt brake on fiscal spending. We could actually see all three growing at the same time, and that kind of demand growth could accommodate that type of supply growth.
And this is against all expectations, is it?
Yeah.
I mean, despite the tariffs. So what's? I mean, is it structurally that the economy is so different than we thought it was, or is it that it actually just focused the minds of politicians and CEOs?
I think that when we look at the environment was when you're in a face with a high uncertainty, you do more spot, less term, meaning you're going to keep buying. And we saw this in 2018 when the last trade war, is that the hard data was very positive and the survey data was really negative. Survey data reflects how people feel. The hard data reflects what's actually happening. As they see the fear, they retract and go more to a spot basis, less on term, and you get that disparity. And as we saw, by the time you got into 19, that gap closed and the economy was doing well. Then COVID struck, obviously, but I think we're in a similar type of setup.
Jeff, I remember this iconic interview that you gave me like over 12 months ago. You said, we're running out of everything and no one's realizing. And you were talking like copper, lithium, and everything, rare earths that we need to help with the energy transition. Is there now is investment back?
No, it's not. And I think you look at drilling in the U.S., it's off. Russia clearly hasn't been investing in oil. They've been fighting a war. Saudi Arabia is focused on Vision 2030. So there's 50% of the world's oil production. They're not focused on massive investment right now. And then you look at the rest of the world, they're not investing. By the time you get 26, 27, we have invested in refineries, drilling for oil capacity, and I don't want to get going on the other commodities. But I think when we look at the misallocation of capital, look at a ratio of equities to commodities or any financial market to commodities. You're just grinding lower and lower. This is going to reverse. I'm very confident in that view. Obviously, the timing, I think we go back to that view. It worked initially into 22 and early 23, but why did it stop? I think one of the reasons it stopped is the prices went too high, too quick, created a marginal increase in supply. Interest rates went up because of the inflationary pressures, and that slowed down particularly the property sector in China. And now we're rebalancing. That story we talked about in 21 and 20, it's still there. The question is what kind of demand growth will expose it? And maybe we see that this year.
There you go. We'll see. We'll follow it very closely. Jeff, as always, thank you so much for coming to see us.
Thanks for having me.
Jeff Currie, Chief Strategy Officer at Energy Pathways at Carlyle. Now, coming up, how European equities and the euro are outperforming as investors shift more money to the continent. We take stock on the final day of the first half of the year. That's next, and this is Bloomberg. Welcome back, everyone. Now, China's top diplomat kicks off a visit to Europe today. The foreign minister, Wang Yi's trip comes as Beijing seeks to improve ties with other trading partners, with its relationship with the U.S. remaining tense and increasingly competitive. Now, let's get more with Bloomberg's Oliver Croak. Ollie, A, I'm so happy you're in London. Two, there's a lot to talk about. So lay out this visit for us. What's actually on the agenda?
Yeah, so the Chinese foreign minister will be going to Brussels. He'll be going to Germany. He'll be going to France for a number of high-level meetings with the foreign ministers, including the EU High Representative Kaja Kallas. And this is really part of the sort of Chinese charm offensive in the wake of the Trump administration going around the world and really saying, listen, we're a reliable partner. You know what you get with us. We're stable going forward. It's going to be kind of a tough audience, though, for him because those countries are ones that, for the most part, do feel the threat that China poses, its industrial strategy to the European Union. Even the Germans, who are a little bit sort of mixed on it, who have been sort of more positive about the Chinese relationship in the past, are a bit more resistant. What they need to get concretely from him is the question of rare earth metals and the magnets that we've been talking about that have been basically cut off by the Chinese in the dispute with the United States. Europe has also been affected, so concretely, that's what they'd like to make some progress on.
I mean, who are his friends?
His friends are in Spain and in Hungary. Spain is a bit in the doghouse after the NATO meeting last week would not agree to spend that 5% target, really sort of upset. But overall, I think that for the most part, even the commission that came into power with the Draghi report as its sort of North Star, they're really cognizant of how much of a threat China poses going forward. There is also the hope potentially for the Europeans that eventually, potentially the Trump administration would want to get to a collective approach on trade with China, maybe bring the Europeans in, though at the moment, as you know, Francine, is sort of a free-for-all on trade, so probably not going to happen anytime soon.
It is a little bit of a free-for-all. Crook, in here all week? Until Wednesday.
Well, until Wednesday, yeah.
There you go. On Wednesday, on the Pulse, live from the studio, our very own Oliver Crook. Now, Europe. Let's focus on Europe, outperforming the U.S. in both stocks and currency, catching the attention of global investors. Some would say finally. It marks quite a comeback after more than a decade in doldrums. So what's driving this shift? And can it last? Well, we're now joined by Michael Msika, our senior strategist for EMEA, equity markets, macro trends, and strategy. Michael, I mean, it's interesting to see finally this shift, a dramatic rebound for European markets.
Yes, Francine, this is something that's quite unusual, especially it's been lasting for quite a few months now. We're seeing a shift of assets from the US to Europe, not in a very, very big manner, but in the kind of a rebalancing portfolio thing. Europe is having a lot of tailwinds at the minute, lower interest rates, a lot of investment in infrastructure, defense. We're seeing the European Union coming together on stimulating the economy, driven by Germany and France especially, and that's getting traction everywhere. So people are talking about Europe, whether it's in the US or in Asia. And European investors are also bringing back some of the assets they invested in the US over the past 10 years.
So how significant is the currency?
It's very significant. But if you look at the long period since the creation of the euro, periods where the euro appreciated like that are usually periods where there is demand for European assets. So it's kind of a mark of confidence into Europe, into the European Union, and into European markets. So I'd say it's a positive.
And how has investor sentiment shifted in the U.S.?
So the people we talk to, especially from large U.S. banks, are all saying the same thing. There's a huge interest from U.S. investors into Europe. The reason is they also need to kind of rebalance their portfolio now, which were very, very concentrated at the start of the year. We're talking the similar type of earning growth for next year between Europe and the US, slightly higher in the US, but at a much cheaper price in Europe. So probably less risks and cheaper price, same growth. People are rebalancing portfolios.
Michael, when you look at Europe, are there any industries that are really benefiting?
So obviously the defense is the main beneficiary, but infrastructure generally is what has been very the interesting trends all over the world. Electrification, everything that's related to cables, to power, is something that investors are looking at. And obviously, what's financing all that? Banks. So banks have been the big driver of European performance over the past few years, and continue to do so.
Thank you so much, Michael Msika, there with the very latest, of course, on some of the European equities. Now to some other stories making news today, and Elon Musk has slammed the Senate's latest version of U.S. President Donald Trump's multi-trillion-dollar tax bill. Now, the Tesla CEO called the cuts to electric vehicle and other clean energy credits incredibly destructive. Musk said the bill would destroy millions of U.S. jobs and give handouts to industries of the past while severely damaging industries of the future. The U.S. president says he's found a buyer for TikTok's U.S. operations, but will not provide details for 2 weeks. Donald Trump told Fox News it was a group of very wealthy people, but the deal will need China's approval, and he expects President Xi Jinping to agree to it. Trump also said he would extend the deadline for ByteDance to sell its U.S. TikTok operations for a third time. And the UK Prime Minister is working to contain a rebellion within his Labour Party ahead of a key vote tomorrow on his flagship welfare policy. Well, Keir Starmer was forced to perform an embarrassing U-turn on plans to cut disability benefits last week. The vote comes a week ahead of the one-year anniversary of Starmer's election win. And temperatures across Western Europe are expected to be 10 degrees above the norm in coming days, with a heat wave brought by a blast of hotter air from North Africa. What's expected to stress power systems and has triggered health alerts. Joining us now is Joe Wirtz, Bloomberg's weather and climate reporter. So, Joe, thank you for joining us. These weather events are becoming increasingly more common. What does this mean for Europe?
Yeah, look, these early season heat waves, the ones that are coming in June, used to happen once every 50 years. New research shows are coming once every 5 years. So it is raising heat stress across all systems. It's something people feel every day as they commute to work, as they get around the city. It's stressing power systems, increasing cooling demand. The heat wave that we're seeing now is bringing big cooling demand increases in the UK, France, Spain. At the same time, those rising temperatures are raising the temperature levels in rivers that are used to cool nuclear plants. We heard, today that EDF in France is going to anticipates cutting production generation out of one of its nuclear plants there due to those rising river temperature levels. So, big cooling demand, power demand increase at the same time affecting the amount of power that can get to the grid.
So how is Europe dealing with this extreme weather, Joe?
Well, they sent out a lot of heat alerts, a bunch in the UK covering the south and the east, including London. We got red alerts in Portugal and heat alerts all across Spain and almost the entirety of France, really. Warning people that temperatures are going to be high, and warning people that the temperatures at night are not going to cool down. That's a big deal. It obviously makes it uncomfortable to sleep. Many homes here don't have air conditioning, but it's an extra concern for young kids, older folks, and people with health vulnerabilities, not having that ability to cool down and get any of that relief at night.
Joe, thank you so much. Joe Wirtz there, our weather and climate reporter. Now, we're just getting some breaking news out of the ECB Vice President, Mr. de Guindos, says he hopes there's a U.S.-EU trade agreement by July 9th. He also says there are doubts regarding U.S. reflected in the dollar. Mr. de Guindos going on to say that the euro could be a reserve currency if Europe does it right. Now, this week, Bloomberg is live at the ECB Forum on Central Banking in Sintra, Portugal. Join us tomorrow as I host a policy panel with the world's top central bankers. That's at 2:30 p.m. London time. And then the U.S. Treasury Secretary Scott Bessent will also be speaking to Bloomberg later. Catch that conversation at 2:30 p.m. London time today. Up next, Bloomberg Brief, and this is Bloomberg.